Did you know that one ETF has delivered over 110% total return in the past decade, another gained about 38% just last year, and the third has rebounded more than 20% since 2023 by backing breakthrough biotech innovation? These aren't just hype, they're real proven results. Today, I'll show you which 3 ETFs could help you build serious wealth starting now. What makes these ETFs powerful is how they work together, balancing stability, growth, and innovation in a single, easy-to-manage portfolio. But before you jump in, it's important to understand why so many investors miss out on long-term success by chasing the wrong opportunities. Speculative trends are everywhere, and it's easy to see why they catch so much attention. Meme stocks light up social media feeds, and cryptocurrencies are constantly in the headlines for their wild price swings. The idea of getting rich overnight is tempting, and stories of dramatic wins seem to be everywhere. But when you look closer, these opportunities are usually built on hype rather than solid financial fundamentals, and that comes with serious risks. Take GameStop as a clear example. In early 2021, its stock price skyrocketed more than 1,500% in just a few weeks, fueled by a surge of social media-driven buying. But almost as quickly as it rose, the excitement faded and the price crashed back down. Many of the investors who jumped in late saw their savings evaporate. This cycle isn't unique to GameStop. Cryptocurrencies have also shown extreme volatility, rocketing up on hype, then crashing when sentiment shifts. These dramatic swings can wipe out fortunes in days or even hours. The headlines rarely mention the majority of investors who lose money trying to time these unpredictable markets. So why do speculative investments so often disappoint? It comes down to 2 main problems: unpredictable volatility and a lack of solid underlying value. Meme stocks and many cryptocurrencies don't rise and fall based on company earnings, real growth, or proven business models. Instead, their prices are driven by social media trends, viral headlines, and speculation. This makes them incredibly hard to predict or time correctly. Even if you get in at the right moment, holding on too long or buying just a little too late can turn potential gains into painful losses. The emotional cost is just as real as the financial one. Watching your investments swing wildly from one day to the next can be exhausting. It's stressful to check your portfolio and see steep losses overnight, with no clear sense of whether things will recover. This roller coaster of hope and fear can distract you from your long-term goals and make it harder to stay disciplined. The constant anxiety of trying to outguess the market drains your focus and can lead to rash decisions that set you back even further. The truth is, most people searching for wealth aren't looking for a thrill. They want real, lasting results. History shows that steady, well-researched investments are actually what build wealth over time. The most successful investors, whether they're famous like Warren Buffett or everyday people who've built solid portfolios, stick to a disciplined approach. They focus on investments with real value, consistent growth, and the ability to weather market ups and downs. This is where ETFs stand out as a smarter alternative. Instead of betting everything on a single stock or chasing the latest trend, ETFs let you invest in a broad basket of companies, sectors, or even entire markets. With a single purchase, you get instant diversification, spreading your risk across dozens or hundreds of investments. If one company or sector struggles, others can help offset the loss. This means your portfolio is less likely to experience the extreme swings you see with speculative assets. And the results speak for themselves. From 2015 to 2025, the Schwab U.S. Dividend Equity ETF, SCHD, delivered over 110% total return with dividends reinvested. For someone who invested $10,000 at the start of that period, that's nearly doubling their money without the sleepless nights or wild swings that come from speculative bets. SCHD didn't achieve this by chasing headlines or gambling on risky trends. Instead, it quietly compounded wealth through steady growth and reliable income. ETFs like SCHD are designed for investors who want to build wealth with less stress and more predictability. They align with long-term goals, letting you participate in the growth of strong companies, emerging industries, and innovative technologies, all while reducing the risk that comes from putting all your eggs in one basket. Instead of riding the emotional highs and lows of speculative bubbles, you can focus on a strategy that delivers smoother, more consistent returns. Not all ETFs are the same, of course. Some focus on steady income, others on growth, and some on capturing the potential of new innovations. The real advantage comes from combining a few carefully chosen ETFs to create a portfolio that balances all three: stability, growth, and exposure to future trends. This approach doesn't just limit your risk, it gives you a better shot at building lasting wealth. Instead of chasing hype, let's look at a portfolio built for steady results. The first step is understanding the power of an ETF that quietly drives both income and growth year after year. SCHD, the Schwab U.S. Dividend Equity ETF, stands out as a proven way to build wealth with a focus on both steady income and growth. Its approach is simple but effective. Invest in high-quality U.S. companies that consistently reward shareholders through growing dividends. Rather than chasing the latest trends or betting on risky startups, SCHD targets businesses with strong fundamentals, companies with healthy balance sheets, reliable cash flow, and a long history of boosting their payouts. This selectivity means you're putting your money behind firms that have demonstrated real resilience through market ups and downs. A major draw for investors is SCHD's current dividend yield, which sits around 3.5%. That's a meaningful source of income, especially in uncertain or inflationary environments where reliable cash flow matters more than ever. Pair that with an ultra-low expense ratio of just 0.06%, and you're keeping almost everything your investments earn. These small details, efficient fees, and a focus on tax efficiency can make a big difference in your long-term results. Over time, less money lost to fees and taxes means more of your returns stay in your pocket, quietly compounding year after year. Inside SCHD's portfolio are some of the most established names in the U.S. market. Broadcom, PepsiCo, Texas Instruments, Verizon, and Lockheed Martin are among its top holdings. Each of these companies has a track record of not just paying dividends, but growing them steadily. This growth isn't just a nice bonus, it's a sign of financial strength and management discipline. By focusing on companies that consistently raise their payouts, SCHD helps you benefit from both regular income and the potential for those payments to increase over time. Let's look at the results. From 2015 to 2025, SCHD delivered a total return of over 110%, and that's with dividends reinvested. If you had invested $10,000 a decade ago, your investment would have grown to more than $21,000. This performance wasn't built on risky bets or market timing. It came from sticking with a disciplined strategy and letting compounding do the heavy lifting. The ETF's lower volatility compared to the S&P 500 also means you're less likely to face dramatic swings that can test your nerves or disrupt your plans. Dividend-focused strategies like SCHD become especially valuable during periods of market turbulence. When stock prices are unpredictable, dividends can act as a cushion, a steady stream of income that keeps working for you even when the market takes a hit. Reinvesting those dividends during downturns can actually help you buy more shares at lower prices, setting you up for even stronger growth when markets recover. SCHD's emphasis on financially stable companies means it tends to hold up better when things get rough, providing a sense of security that's hard to find in more speculative investments. SCHD isn't just about defense, though. It fits seamlessly into a broader portfolio, offering a reliable base that supports other investments focused on growth or innovation. Think of it as the steady engine in your investment strategy, quietly generating returns while freeing you up to pursue opportunities elsewhere. This balanced approach can help you weather different market conditions while still capturing upside potential from emerging trends. For investors who want to avoid the noise and focus on results, SCHD offers a practical solution. It's not about chasing the hottest stock or betting on unpredictable sectors. Instead, it's about building wealth through the power of compounding, reinvesting dividends, and trusting in companies with proven track records. Over time, this steady approach can turn even modest investments into substantial gains, especially if you start early and let your money work for you. Accessibility is another key advantage. SCHD's low fees and focus on dividend growth make it a smart choice for both new and experienced investors. Whether you're aiming to supplement your retirement savings or looking for a way to generate passive income, SCHD delivers simplicity and consistency, qualities that are often overlooked but incredibly valuable in the long run. While SCHD lays a strong foundation for wealth building, there are other opportunities that can add a powerful growth element to your portfolio. One area drawing increasing attention is the global push for clean energy and the unique role a certain resource could play in shaping the future. URA, the Global X Uranium ETF, is a focused way to capture the momentum behind nuclear energy as the world looks for reliable and scalable clean power sources. This ETF gives you direct access to the companies powering the nuclear sector, from uranium miners to firms building and maintaining nuclear infrastructure. What sets URA apart is its ability to tap into a sector that's not just growing, but is also increasingly supported by government policies and global energy strategies. Nuclear energy stands out because it provides steady, around-the-clock electricity without the carbon emissions that come from burning fossil fuels. Unlike wind or solar, nuclear doesn't depend on the weather, making it a backbone for countries seeking both energy security and sustainability. At the core of this transition is uranium, the essential fuel for nuclear reactors. As more governments commit to reducing carbon emissions and securing their energy supplies, demand for uranium continues to climb. URA's portfolio is built to benefit from this structural shift, holding companies that are critical to the supply chain, such as Cameco, NextGen Energy, and Kazatomprom. These firms play a key role in mining, refining, and delivering uranium to meet the needs of a growing number of reactors worldwide. Performance has reflected these trends. Over the past 12 months, URA returned about 38%, driven by rising uranium prices and renewed interest in nuclear power as part of clean energy policies. If you look at an 18-month window, the ETF saw a 40% price increase, showing how quickly sentiment can shift as nuclear energy gains wider acceptance. This growth isn't just about market speculation. It's backed by real changes such as new reactor construction, upgrades to existing plants, and long-term government contracts to secure uranium supplies. One policy factor helping URA is the move by governments and regulatory bodies to officially recognize nuclear energy as a sustainable investment. For example, the European Union has classified nuclear as green under its sustainable finance taxonomy, making it easier for capital to flow into the sector. In the US, recent government subsidies and incentives for nuclear infrastructure have further boosted the outlook for uranium demand. These policy tailwinds create a supportive environment for the companies in URA's portfolio and add a layer of stability to what has traditionally been a volatile sector. Of course, investing in uranium and nuclear energy isn't without risk. The sector is naturally volatile, with prices swinging based on global supply and demand, geopolitical events, and regulatory changes. Even positive trends can be interrupted by shifts in policy or sudden changes in energy markets. That's why a practical approach like dollar cost averaging, investing a set amount at regular intervals, can help smooth out the bumps. By spreading your investment over time, you reduce the impact of short-term price swings and position yourself to benefit from the broader, long-term growth in nuclear energy. URA's expense ratio is 0.69%. While this is higher than some broad market ETFs, it's a reasonable trade-off for exposure to a sector with such significant upside potential and global relevance. You're not just investing in a single company or taking on the risks of individual miners. You're gaining diversified access to an entire supply chain that's benefiting from both political momentum and economic necessity. What makes URA compelling isn't just its past performance or the companies it holds. It's the convergence of necessity and opportunity. As governments around the world invest in nuclear energy to achieve their climate goals and secure stable energy, the demand for uranium becomes more predictable and resilient. This isn't just about chasing a trend. It's about aligning your investments with a long-term transformation in how the world generates power. With URA, you add a growth engine to your portfolio that's rooted in real-world demand and global policy shifts. But while energy is a critical part of the future, there's another area where innovation is rewriting the rules at an even faster pace. This next opportunity gives you a way to participate in breakthroughs that could change lives and create new markets without having to pick a single winner. XBI, the SPDR S&P Biotech ETF, puts you right at the heart of medical innovation. Instead of picking one company and hoping for a breakthrough, you gain exposure to dozens of biotech firms working on the next generation of treatments, gene editing, mRNA vaccines, and AI-powered drug discovery. This ETF focuses on early and mid-stage companies, many of which are developing therapies that could redefine healthcare in the coming decade. Some of the standout features of XBI is its equal-weighted structure. Unlike traditional ETFs, where a handful of large companies dominate performance, XBI gives each holding about the same influence. This means smaller, agile biotech firms, often the true drivers of innovation, can have just as much impact as more established names. If a small company announces a successful clinical trial or secures FDA approval, the effect on XBI can be substantial. At the same time, this structure cushions the impact of any single clinical failure or sudden setback, helping to manage risk in a notoriously volatile sector. The biotech industry is undergoing rapid transformation. AI is streamlining drug discovery, making it faster and less expensive to identify promising compounds. Gene editing tools like CRISPR are moving from research labs into clinical applications, opening new possibilities for treating genetic diseases. Immunotherapy, meanwhile, is shifting from experimental to mainstream, offering new hope for patients with conditions that were once untreatable. XBI's portfolio captures these trends by investing in companies at the cutting edge. Firms like CRISPR Therapeutics, NLM Pharmaceuticals, Intellia Therapeutics, and Sears Therapeutics. These names represent the front lines of biotech, where breakthroughs can quickly turn into real-world solutions. XBI's performance over the past few years tells a story of both challenge and opportunity. After peaking in 2021, the ETF experienced a steep decline, falling about 45% as market sentiment turned negative and valuations reset. But from 2023 to 2025, XBI rebounded by more than 20%. This recovery wasn't just a bounce. It reflected the sector's resilience and the emergence of value-priced opportunities. As technologies like gene editing and AI-driven drug development progressed from theory to practice, investors who stayed the course saw renewed momentum and significant gains. Cost efficiency is another advantage. XBI's expense ratio sits at 0.35%, which is competitive for a fund focused on such a specialized, high-upside sector. Many niche ETFs charge much more, but XBI keeps fees in check, allowing you to keep more of your returns. This matters even more when you're investing in an area where the upside can be substantial, but volatility is part of the landscape. There's also a powerful dynamic in biotech that goes beyond product launches, mergers, and acquisitions. Larger pharmaceutical companies often look to smaller innovative firms to fill their pipelines with new therapies. When a big player acquires a biotech company, it can trigger sharp price jumps for that stock. Because XBI holds a broad mix of these smaller firms, investors can benefit from this M&A activity without having to predict which company will be next. This adds another layer of potential upside to the ETF, capturing both organic growth and the value created by acquisitions. Of course, biotech investing comes with risks. The sector is known for its sharp swings. Optimism over promising treatment can quickly turn to disappointment if a clinical trial fails or regulatory approval is delayed. But XBI's structure spreads risk across many companies, so a single setback doesn't derail the whole investment. For long-term investors, these dips can present chances to add exposure at lower prices, especially when the underlying trends remain strong. The pace of innovation in biotech is only accelerating. As AI, gene editing, and novel therapies continue to expand their reach, the sector's potential to transform healthcare grows. XBI makes it possible to participate in this transformation without the need to pick individual winners or accept the full risk of betting on a single company. You get access to the upsides of breakthroughs, the resilience of diversification, and the efficiency of a well-managed ETF. Bringing XBI together with SCHD's stability and URA's growth focus creates a portfolio that balances consistency, diversification, and alignment with the trends shaping the future. This combination sets the stage for building wealth throughout a thoughtful, forward-looking investment strategy. As you consider your next steps, think about which of these three ETFs, SCHD, URA, or XBI, aligns most with your goals and interests. Each offers a distinct advantage: SCHD for steady income, URA for growth tied to clean energy, and XBI for innovation in healthcare. These aren't hype plays. They're strategic tools for building lasting wealth quietly and efficiently. Let me know in the comments which ETF you're most excited about or already investing in. If you found this video helpful, hit the like button and subscribe for more straightforward investing content. Starting small today can build a portfolio that lasts decades.